How should you invest your money during a key period? Imagine a time when borrowing money becomes easier and the cost to do so drops significantly. That's what happens during a period of quantitative easing. Central banks buy long-term government bonds and other assets to boost the economy. This flood of money lowers long-term interest rates and encourages spending and investment. When interest rates fall, traditional fixed-income investments like government bonds tend to offer lower returns. Investors often look for higher yields elsewhere, which can push stock prices higher. Stocks in sectors like technology, consumer discretionary, and real estate investment trusts tend to benefit because they thrive when borrowing costs are low and economic activity increases. Real estate markets also tend to do well during quantitative easing. Lower mortgage rates make buying homes more affordable, which can boost housing demand. Companies find it cheaper to issue debt, so corporate bonds may increase in value. Keep an eye on these markets if you want to align your investments with the environment created by central bank policies. Inflation is another factor to consider. Quantitative easing aims to prevent deflation and stimulate demand, but it can also lead to rising inflation expectations. To protect your money, consider assets like Treasury inflation-protected securities, commodities, or real estate. These assets tend to hold their value when inflation picks up. Currency movements are also affected. Quantitative easing can weaken the domestic currency because of increased money supply. A weaker currency can help exporters and companies earning overseas revenue but may raise the cost of imported goods. If you have investments in foreign markets or companies that export, this could be a positive sign. During a quantitative easing period, diversifying your portfolio is key. Focus on stocks that benefit from low interest rates and economic growth. Consider adding corporate bonds or emerging market debt for higher yields. To hedge against inflation, include assets like Treasury inflation-protected securities, commodities, or real estate. Stay informed about central bank signals because these policies are not permanent. When central banks start to tighten monetary policy, asset prices can change quickly. Watching for signs of policy shifts will help you adjust your investments accordingly. In summary, during a quantitative easing period, it's wise to focus on risk assets like stocks and real estate, seek higher yields in corporate or emerging market bonds, and protect against inflation with specific assets. Keeping an eye on monetary policy changes will help you stay ahead of market shifts and make smarter investment choices.